Hi, I am Bhoj Raj Pangeni. Welcome to the finance class with Bhoj Raj Pangeni. Today's lesson we are going to solve about the numerical problem of common stock and investment banking problem. Here is some formula. Net worth, equity fund, shareholders fund, book value per share. All are same. Similar name, synonyms. Equal to common stock par value plus share premium. We can say it as additional paid in capital also. Additional paid in capital and share premium are same thing. And retained earning means the net profit after distributing the dividend, and general reserve and minus treasury stock. Treasury stock means the stock that has been buybacked by the company. So we can deduct the treasury stock. And second formula is number of the share outstanding equal to number of the shares issued share minus number of treasury stock, because the treasury stock is buybacked by companies, so we have to deduct to get the number of share outstanding in the market. Book value per share, BVPS, sometimes it called net worth per share, that is net worth divided by number of share outstanding. Number of share outstanding has been already computed in formula number 2. So net worth divided by number of share outstanding equal to rupees per share. This is the units. Book value of company, book value of shares. Here is the book value of share and the book value of company. Both are not same. They are different. Book value of share means book value of equity shares that has been recorded in the books of account. But the book value of company means the value of company that has been recorded, that has been enlisted in the books of account. What is the books of account? That is the total assets or total liability. The balance sheet is the books of account. And here is the total assets or total liability side. Total assets or total liability side are equal in the balance sheet. So this is the books of account, and total assets value and total liability value is the book value of company, recorded value of company. So book value of equity and book value of company or book value of firm are different thing. Now, debt equity ratio. The name itself said debt equity ratio. So total debt divided by shareholders fund into 100%, into 100%. And number of share to be issued. This is the another investment banking process up to the 1 2 3 4 5. These five upper five formula are related with the book value per share. And now the turn goes to the investment banking process. Number of share to be issued equal to funds to be raised plus issued cost divided by issue price minus underwriter cost per share. This is the underwriting process or investment banking process. So we have to compute it those types of numerical problem. So we have to know about this formula. Next formula is the underwriter spread. The spread means the profit, that is the profit means the income minus expenses. So underwriter spread equal to the underwriter income minus underwriter expenses, or we can say the another formula, the underwriter spread equal to gross. Here is the question regarding the book value per share. The question: the liability side of the balance sheet has been provided to you. Share capital, authorized share capital 20,000 shares at the rate of 100 each. This is the 20,000 shares is the authorized share capital, and the value of share capital is 1.5 million, that is 1,500,000. That is it may be a issued capital. And the another item is additional paid in capital, or we can say it as a share premium sometimes. And retained earning, treasury stock. Treasury stock is deducted because it is the buyback share, company buyback its share. And the long term loan, it is the debt item, and the current liability, it is also the debt item. These last two items are the debt item. And the A number required a book value of the firm, B shareholders fund, C net worth per share, D debt equity ratio, and E if the firm wants to issue the additional remaining authorized share including treasury stock. That is, the including treasury stock means the company also issue the treasury stock again. Net rupees 230 per share, it means the company can get 230 per share in net after issuing those shares. What would be the BVPS? That is new BVPS equal to what? Here is some solution. A book value of the firm equal to the total liability side of the balance sheet. That is 1.5 million plus 150,000, 450,000 minus 100,000, 500,000 plus 300,000 plus. These are the liability side of the balance sheet as shown in the question. And we can get rupees 2.9 million or 2,900,000 rupees. And the problem is shareholders fund. The shareholders fund formula is the common stock, that is par value plus share premium plus retained earning minus treasury stock. The value of common stock is given in the common stock means the share capital. This is given in the question as 1.5 million or 1,500,000. And the share premium is the additional paid in capital. Additional paid in capital and the share premium are same. And retained earning, treasury stock are given in the question. We can get rupees 2 million as a shareholders fund. Shareholders fund and net worth is same. See, net worth per share. The formula net worth per share is equal to net worth divided by number of share outstanding. We have already calculated the net value of net worth, that is in part B. Shareholders fund is the net worth, so 2 million is the net worth, but we cannot have a number of share outstanding anywhere in this question, so we have to calculate the number of share outstanding. Now we are going to calculate the number of share outstanding in the working note. Number of issued share, that is 1,500,000 divided by 100, because the 100 is the par value, so we can divide it, the total value, by the par value. We can get the number of share issued. This 20,000 is the authorized share capital, and this 15,000 shares are the issued capital, number of issued capital, issued shares. And the number of treasury stock equal to the value of treasury stock is given as 100,000, and we don't have any information regarding the company, the stock price of the stock of buyback. So we can assume that the company can buy back its share in par value, so we can divide rupees 100,000 divided by 100. We can get 1,000 share as a number of treasury stock. Now we can get the number of share outstanding as the number of share issued minus number of treasury stock. Now 15,000 minus 1,000 equal to 14,000 is the number of share outstanding. Now we can then we go to the part C problem, that is 20,000 net worth as calculated in the part B, and the 14,000 shares number of share outstanding as calculated in the working note. We can get the net worth per share. as the answer. Debt equity ratio, that is total debt equal to the long term debt plus current liability. Long term debt equal to the 500,000 and current liability is 300,000. So we have 800,000 rupees as a total debt, and the debt equity ratio equal to the total debt divided by shareholders fund, that is shareholders fund already calculated in part B, 2 million, and into 100%. We can put the value 800,000 divided by 2 million into 100%. 40% is our debt equity ratio. And the last one is new BVPS, remaining authorized share including treasury stock, that is remaining authorized share. The total authorized share is 20,000 shares and the number of shares issued is 15,000 shares. We can get the remaining authorized share 5,000 plus 1,000 shares are buyback by a company. So we can get 6,000 shares are remaining. The company can issue the 6,000 shares and the issue price is 230 per share, or net value, net proceed has been come is 230 per share. What is the value of book value per share? Now we know that new book value per share equal to the old net worth plus new addition. Old net worth plus new addition in net worth divided by old number of share outstanding plus new addition in share outstanding. Old net worth, that is 2 million, and old number of share outstanding, that is 14,000 we have. But new addition in net worth, what does it mean? The new addition in net worth means the company is going to issue 6,000 shares at the rate of 230 per share. So we are going to calculate solve problem about the underwriter investment banking process. Here is the question, read the carefully. ABC company wants to raise rupees 2 million through new issue of shares. The company's current stock price is 300 per share in the secondary market. The underwriter informed the management to set the share price 100, share price 10% less than market price. The issue cost incurred by the company of rupees 50,000. Beside this, the underwriter takes the 5% as the commission. This is the question. Now, first of all, we have to required number of share issued by the company to raise the required amount, and B, if the underwriter incur rupees 60,000 administrative cost for the issue of shares, find the underwriter spread. We have to, first of all, we have to get the given information. The 2 million rupees is the fund to be raised. The company wants to raise rupees 2 million, that is fund to be raised by the company. And this 300 stock price is the current stock price. We can say current selling price P0 equal to 300 per share. And now the company, the underwriter informed the management to set the share at shares the price 10% less than market price. Market price and the current selling price are the same. So 10% less is the issued price. So issue price is the 10% less of P0, that is 300. We can get 300 minus 10% of 300, we can less. So the issue price be 270 per share. And the another information is the issue cost incurred by the company. the issue cost incurred by the company 50,000 rupees. Now, underwriter commission is the 5% of 270. Here is 270. We have to calculate it. The underwriter commission is only calculated on the issue price, not to the market price. So we have to aware the underwriter commission is calculated in issued price, not the market price, and par value whatever. So we can get the 5% up to 70 as 13.5 per share. And A number questions, number of shares to be issued is what? And the underwriter expenses equal to the 60,000. Underwriter spread equal to what? This is the given information you can write in the copy. Answer, number of share to be issued equal to the fund to be raised plus issue cost, that is the total issue cost, fixed cost, not to the per share value, that is the fixed cost, upon issue price minus underwriter commission, that is the underwriter commission minus is the per share value commission. So 2 million is the fund to be raised information in, and the issue cost is the 50,000 issue cost. This cost is the total fixed cost issued, and the 270 is the issue price minus 13.5 is the underwriter commission per share. If the per share value is given as a cost, we can deduct it as a issue price, because the issue price is also the per share value. So the 13.5 is the also the per share underwriter commission, and fund to be raised is the total value, and the 50,000 is the total cost, issued cost, total issue cost, fixed cost. So we have add up. We can get 7,992.20 shares. We cannot issue the shares in fraction, so company have to issue 7,993 shares to get rupees 20 million. And another problem is underwriter spread. Underwriter spread equal to the underwriter's income minus underwriter's expenses. Underwriter's income is the commission. The commission is the underwriter income. That is 7,993 shares is going to issue by the company, and the underwriter get 13.5 as the underwriter commission. So this commission is the income to the underwriter, and the underwriter expenses is given in the problem B part. We can deduct it 60,000. Now we have rupees 47,905.50. That is the underwriter spread. We can calculate it this value by another formula, that is, now you are requested to subscribe the channel for upcoming video. Thank you.